Welcome back to Talk Tickers. Today, we are locking in on a ticker that just woke up the entire healthcare sector. We're talking Cardinal Health, ticker symbol CAH. And folks, if you looked at your screens this morning, February 5th, 2026, you saw a very distinct shade of green.
Oh, it was hard to miss. The stock popped roughly 9% right out of the gate.
Yeah.
Hitting highs around, what, $211?
And usually when you see a move like that in something as steady, dare I say, traditionally boring as medical distribution, you assume it's a sell the news event.
Right. You know the drill.
Big hype and then the inevitable drop when reality sets in. But this felt different.
This was definitely not sell the news. This was a buy the execution event.
Okay, say more about that.
The market reaction is telling us that investors aren't just reacting to a single lucky quarter. They're repricing the company's ability to actually deliver on its promises.
Exactly. The narrative for years has been that this is a low-margin, volume-heavy game.
Moving boxes.
Right. Fighting for pennies on the dollar. But what we saw in this Q2 print suggests Cardinal is flipping that script. It's a clean beat and raise, and honestly, it looks like their pivot to specialty is finally printing money.
It really is the headline here. They are proving they can transition from just moving product to, actually managing complex, high-margin care.
Yeah.
But before we get into the weeds of the strategy, and we need to talk about nuclear medicine later because that is wild, we have to look at the scoreboard.
Oh, for sure.
Because the numbers this morning were just impressive.
Okay, let's unpack the headlines. Top and bottom line, what are we looking at?
On the bottom line, adjusted EPS came in at $2.63.
And what was the consensus?
Consensus estimate was sitting at $2.36.
So that's a 27-cent beat. In this kind of mature industry, that is a massive gap.
It's a huge beat.
Huh.
That represents 36% year-over-year growth.
Wow.
And on the top line, revenue hit $65.6 billion.
$65.6 billion.
Yep, up 19% year-over-year, beating consensus by nearly $1.5 billion.
19% revenue growth for a company of this size. That's incredible.
It's massive.
Usually companies this big grow at, GDP levels, 3-4%. But here's where it gets really interesting for me, the guidance. Because beating a quarter is one thing, but telling the street, hey, we're going to keep doing this is another.
Right, and they did. Management raised the full-year fiscal 2026 EPS guidance again.
And the new range is?
$10.15 to $10.35.
Okay, context for me. Where was the street before this?
The street was sitting roughly at $10.02. And remember, Cardinal's previous floor was just at least $10.
Right.
So they didn't just inch it up. They leapfrogged expectations. They're basically saying, we aren't just hoping to hit $10, we're planning to blow past it.
And looking at the breakdown, this wasn't just one lucky segment carrying the team, was it?
No, and that's the sign of a healthy business. All 5 operating segments delivered double-digit profit growth.
All 5.
Total operating earnings on a non-GAAP basis hit $877 million, up 38% year-over-year.
38% profit growth. Okay, so let's get into the engine room. The biggest piece of the pie here is the Pharma and Specialty Solutions segment. What is driving this beast?
This is the core engine. Revenue in this segment was up 19% to $61 billion.
Okay.
But more importantly, segment profit was up 29% to $687 million.
And the magic word here is specialty.
It is. Management explicitly confirmed that specialty revenues are on track to surpass $50 billion in fiscal 26.
$50 billion. That is just a staggering number for a subsegment. But I want to pause on something you mentioned. We hear specialty, but they also talked about hub services and Sinexus. I feel like people just glaze over those terms. Can we break down what that actually means?
It's a great point because this is where the business model is really changing. Think about hub services as the operating system for specialty drugs.
Okay, lay it out for me.
Imagine you're a doctor. You diagnose a patient with a rare cancer or something, and you prescribe a drug that costs, $50,000 a year.
Right.
You don't just write a scribble on a pad and tell the patient to go to the corner drugstore.
No, the pharmacy probably doesn't even stock it.
Exactly. And the insurance company definitely doesn't want to pay for it without a fight. There's a mountain of paperwork, prior authorizations, financial assistance apps.
So the doctor is just drowning in admin work.
Precisely. Cardinal's Sinexus hub business effectively sits in the middle. They handle the bureaucracy.
They navigate the insurance maze.
They do. They coordinate the logistics. They onboard the patient. Management noted they onboarded 1 million new patients via these hub programs.
1 million. That is incredible. So they aren't just the delivery truck. They are the administrative back office for the entire treatment.
Correct. And that is a very sticky relationship.
Yeah.
Once a manufacturer and a hospital system are integrated into your hub, it's very hard to switch.
Sure.
They also supported roughly half of all new 3PL product launches in calendar 2025.
Wait, half?
Half. So if a manufacturer launched a new drug last year requiring third-party logistics, warehousing, shipping, there was a 50-50 chance Cardinal was handling it.
That is dominance. That's wild. But I have to play devil's advocate here.
Go for it.
I look at that 19% revenue growth, and I have to ask about the elephant in the room.
The GLP-1s?
The GLP-1s, the weight loss drugs like Ozempic, Wegovy. Be honest, is this beat just Cardinal riding that wave?
That is the question everyone asks, and the answer is surprisingly nuanced. Management addressed this head on.
Okay.
Yes, GLP-1s contributed about 6 percentage points of revenue growth.
Okay, so that's a big chunk of the top line.
It is heavily driving revenue, yes. But, and this is the crucial distinction, management explicitly stated that while GLP-1s lift revenue, they are not major near-term profit drivers.
Hold on, I want to challenge that. Everywhere I look, GLP-1s are the only story. You're telling me a distributor moved billions in these drugs and it barely moved the needle on profit. How?
It comes down to the margin structure. These are high-cost, brand-name drugs with very slim distribution upgrades.
Yeah.
Cardinal makes pennies on the dollar moving them. So the revenue number explodes because the drugs are so expensive, but the profit line, it stays pretty flat.
So the profit beat that 38% jump that isn't from the weight loss drugs.
Exactly. And that makes the quality of this beat much higher. If this was just a low-margin volume spike, the market might shrug it off. But the profit is coming from core execution, the specialty mix, and their generics program.
That is a relief, honestly. It means the foundation is solid. Speaking of which, let's talk generics, Red Oak sourcing.
It's performing well. Red Oak, their joint venture, they noted that generic unit volume growth actually exceeded their long-term expectations.
And generics are good for margin.
Right. They're a higher margin stabilizer for the business.
Yeah.
So you have this flashy growth of specialty combined with the rock-solid volume of generics.
Okay, so the main engine is firing on all cylinders. But let's talk about the comeback kid. The segment that used to be the problem child, GMPD.
Global medical products and distribution.
Yeah, for a while, this was the drag on the stock. What's the verdict this quarter?
The turnaround is real. Revenue was up 3% to $3.3 billion, which is fine. Nothing to write home about.
But the profit.
But look at the profit. Segment profit doubled.
Doubled.
Went from $18 million in the prior year to $37 million this quarter.
That is a massive swing. What changed? Are they just selling more gloves?
It's not just volume, it's the mix. They raised their full-year profit outlook for the segment to about $150 million. Cardinal Health brand sales were up 10% in the U.S.
Okay.
But the real winner was a specific device they mentioned, the SmartFlow.
I saw that in the notes. The SmartFlow, intermittent pneumatic compression device. What does that do?
It's for DVT prevention, deep vein thrombosis. It prevents blood clots in patients who are bedridden or recovering from surgery. It squeezes the legs to keep blood moving.
Okay, so why does that matter for the stock?
Because it proves they can win on clinical differentiation. Yeah. They aren't just shipping commodity gauze and latex gloves where only price matters.
Right.
They're launching proprietary tech that hospitals actually prefer. They said it's exceeding launch expectations.
That makes sense. Innovation drives margin. But I also noticed management was pretty transparent about some inventory stuff here, too.
They were, and I appreciate that. They flagged that about 3 to 4% of that brand growth was due to distributor inventory restocking.
Okay.
Basically, their customers bought a bit more than usual, and they expect that to normalize in Q3.
Right, so don't expect that exact same pop next quarter, but the underlying trend is still positive.
Exactly. But the real story in GMPD is on the cost side. SG&A expenses in this segment actually decreased.
Wait, expenses went down in this economy?
I know, right? It proves their simplification plan isn't just corporate speak. They are actually stripping out complexity, making the segment leaner.
Which is why profit doubled even though revenue was only up 3%.
That is the definition of operating leverage.
Okay, let's move to what I think is the sleeper hit of this report. The other segment, usually other, is where companies hide the boring stuff. But for Cardinal, this includes nuclear and at-home solutions, and the numbers here are explosive.
Other is definitely a misnomer here. Revenue was up 34% to $1.7 billion, and segment profit
Tell me.
up 52% to $179 million.
52% profit growth. That is tech company growth, not some utility healthcare distributor.
It really is. And as a result, they hiked the guidance for this segment's profit growth to 33 to 35% for the full year.
So what is driving this rocket ship?
Two main things, nuclear and at home. But we have to spend a minute on nuclear, specifically Theranostics.
Theranosticks. I love that word. It sounds so futuristic. That's the combination of therapeutics and diagnostics, right?
Correct. It's using radioactive isotopes to find cancer and then using different isotopes to kill it. It's huge in oncology urology.
And the growth there.
Cardinal's revenue growth in Theranostics is exceeding 30%.
Okay, but here's my question. Why is Cardinal winning here? Why can't a startup just do this?
This is where the physics of the business creates a moat. We aren't shipping books or shoes. We're shipping radioactive material.
Right, it's dangerous.
It's not just dangerous, it's a race against time. These isotopes have half-lives. Some of them decay in just a few hours.
Meaning if the truck gets stuck in traffic, the product literally disappears.
Literally. If a dose is meant for a patient at 2.0 p.m. and it arrives at 6.0 p.m., it might be useless.
Wow.
It's decayed into nothing. You can't inventory this stuff on a shelf. You have to manufacture it, prep it, and deliver it in this tight, synchronized window.
So you need a whole network of nuclear pharmacies that are basically hyper-local manufacturing sites.
Exactly. And Cardinal has the largest network in the country. To replicate that would be an enormous undertaking. It's an incredibly high barrier to entry.
That creates a serious moat. And they mentioned a pipeline for this, too.
They did. Over 70 products in the pipeline. This is the cutting edge of personalized medicine, and Cardinal is the infrastructure that makes it all possible.
Incredible. And then quickly on the at-home side, what's happening there?
That was boosted by the acquisition of ADS Advanced Diabetes Supply. The integration is going well, and it's creating a platform for chronic condition management in the home.
I also saw a note about OptiFreight.
Yeah, their logistics business. Revenue grew over 30% there as well. So essentially, every single subcomponent of this other segment is growing at 30% or more.
It's like they have this hidden growth equity portfolio sitting inside a value stock.
That's a great way to put it. And it connects back to the broader strategy. They are positioning themselves around the patient, wherever that patient is.
So let's zoom out. We've got the numbers, we've got the segments. What about capital allocation? How are they treating shareholders?
Very friendly. They repurchased $375 million in shares this quarter.
And year to date?
$750 million.
And usually when companies are buying back stock and acquiring companies like Solaris, they are racking up debt. Is the balance sheet getting stretched?
Surprisingly, no. This impressed me. Their Moody's adjusted leverage ratio is back down to 3.2 times.
Okay.
That is squarely within their target range. And they hit this target ahead of schedule.
So they bought a company, bought back stock, and still delevered.
That speaks to the cash flow generation of the business. It's a machine.
Now, I have to ask about the macro stuff. The Inflation Reduction Act, drug pricing. Is there any panic there?
Not really. Management addressed it pretty calmly. Their stance is that the impact is already baked into the guidance.
But help me understand that. If the price of the drug drops, doesn't Cardinal make less money? A smaller pie means a smaller slice, right?
That's how many people think it works. But it's different. Think of it like a toll booth.
Okay, a toll booth.
Cardinal isn't paid a percentage of the car's value. They are paid a toll for letting the car pass through the highway.
Right.
If the price of the drug drops, the manufacturer still has to pay the same toll to get it to the pharmacy.
Ah, I see. So even if the list price, the WAC, goes down, their fee is protected.
Largely, yes. Their contracts are structured to protect those margin dollars. So revenue might fluctuate, but the actual profit they keep stays steady.
That's a crucial distinction. Okay, one last thing. Domestic manufacturing, PPE. Is Cardinal ready for any Buy American push?
They said they are agnostic, but capable. If the market wants to pay for domestic PPE, they can provide it. But they noted that right now, customers still prioritize the lower cost of global sourcing.
Flexible. I like it. So what does this all mean for the listener? We have a beat, a raise, a stock at all-time highs.
It means the thesis has shifted. This isn't a turnaround story anymore, it's a growth story. The GMPD turnaround is stabilizing, but the growth in specialty and nuclear suggests a structural mix shift towards higher margins.
It's not just driving a truck anymore.
No, it's managing nuclear medicine and running urology clinics, and that deserves a higher multiple than just a standard wholesaler.
All right, that brings us to everyone's favorite segment. We've looked at the past, the present. Now let's get a little crazy about the future.
Let's do it.
This is not financial advice segment, or as I like to call it, the do not sue us zone.
Seriously. Turn off your responsible investor brain for a minute.
Exactly. If you trade on what we are about to say, you are on your own. This is purely for entertainment.
We are just two voices on a podcast.
Okay, here is the pitch. I call this trade the radioactive urologist.
The radioactive urologist. That sounds like the worst superhero movie ever made.
It does, but hear me out. We look at Cardinal Health and we see a boring distributor. But I look at the data we just discussed, and I see a vertically integrated oncology tech play hiding in plain sight.
Okay, walk me through the logic.
Point one, they bought Solaris. They now own the urology clinics where patients go for prostate cancer treatment. Point two, their nuclear division is booming up 30%, specifically in Theranostics, which is heavily used for prostate cancer.
Okay, I see where you're going. They own the patient intake at the clinic.
Right. And point three, they control the cure via the nuclear supply chain. They are closing the loop.
They're capturing the value at the point of diagnosis and at the point of treatment.
Exactly. So here's the trade. You go long Cardinal Health, CAH, as a stealth oncology tech play. But you fund it, and this is the spicy part, by shorting independent regional urology clinic chains.
Oh, that is ruthless.
Why? Because the independent clinics don't have the supply chain scale. They can't afford the new theranostic equipment or the logistics to handle radioactive isotopes. Cardinal is going to squeeze them?
So you're betting that the mom and pop urology clinics get crushed by the giant who owns the nuclear fuel, basically.
Exactly. You're buying a tech growth multiple because Theranosticks is tech, but you're paying a wholesaler valuation for it. That's the alpha.
It's outrageous, but it's actually incredibly plausible.
Right.
Consolidation in healthcare favors the ones who own the infrastructure. And nobody owns nuclear infrastructure like Cardinal.
There you have it. The radioactive urologist. You heard it here first.
Just don't put it in your retirement account.
Absolutely not. All right, let's wrap this up. Recap for the people in the back.
Clean beat at $2.63. Guidance raised to a range of $10.15 to $10.35.
And the big picture.
Specialty and nuclear are the real growth engines. Pharma distribution is the cash cow funding it all.
And the final thought.
The turnaround in medical products, combined with the explosion in specialty, suggests this isn't just an inflation trade. It's a structural change. Cardinal Health looks different today than it did 3 years ago, and the market is finally waking up to it. There it is. That was the breakdown of the Q2 FY 2026 call for Cardinal Health. As always, do your own homework.
We're just here to help you dig a little deeper.
See you on the next print.